The Federal Reserve is unlikely to tame inflation without pushing the American economy into recession, CNN reported. Most economists from the National Association of Business Economics experts then expect the new US recession will begin by the middle of 2023, but in some opinion it's already started. That gloomy finding, including nearly 1 in 5, 90%, who saw the economy is already in recession, as determined by the National Economic Research and BER. Another 20% of forecasters do not expect a recession to begin before the second half of next year. Survey results reflect many split opinions among the panelists. This by itself suggests there is less clarity than usual about the outlook. Last month, Fed Chairman Jerome Powell agreed during a press conference that there's still a path to getting inflation under control without sparking a downturn. However, even Powell considered that path has gotten narrowed as the Fed has been forced to resort to drastic interest rate hiking to knock down inflation. Recession watch. Fears return as Fed warns Americans of some pain as economy braces for more job cuts. Most experts still aren't ready to declare a recession is around the corner, but Fed Chair Powell has grown increasing caution in warning that the economic consequences of higher interest rates, though they had recently cooled fears of an impending recession, once again escalated Friday after Federal Reserve Chair Jerome Powell warned economic growth will suffer as the central bank works to ease decides high inflation driving a steep stock market decline, as more experts worry that even the recently strong job market could soon start to show signs of weakening. Is in this highly awaited Jackson Hole speech on Friday, Powell hawkishly proclaimed the Fed would forcefully use its tool to combat inflation. Doing so well requires a sustained period of below-trend growth. That will bring some pain to households and businesses. Most experts still aren't ready to declare a recession is around the corner, but Fed Chair Powell has grown increasingly cautious, is warning to the economic consequences of higher interest rates. Though they had recently cooled fears of an impending recession once again escalated Friday after Federal Reserve Chair Jerome Powell warned economic growth will suffer as the central bank works to ease decides high inflation driving a steep stock market decline, as more experts worry that even the recently strong job market could soon start to show signs of weakening. Commented to restrictive policy that will eventually get this economy into a recession in order to cool inflation that has remained near 40 years highs for the majority of this year. The Fed is flipping the script. Investment management. Nothing there. Notice the central bank long supported the market with low interest rates and as accommodatively accommodatively policy during the pandemic, but now emphasizes price stability, shifting its focus as it did before the Great Recession. The Fed is okay with risking a recession in order to lower inflation and raises the odds of one occurring over the next year. Labor market. Here will very likely be some softening in the labor market as the Fed works to bring down inflation. According to PwC, about 50% of United States executors are considering or planning on cutting a job within the next 6 to 12 months. Stock market. If the Fed is going to raise interest rate until the United States enters recession, then the stock market needs to be down 20 to 30% from its prior peak. After climbing 21% last year, the SP is down nearly 15% this year. Housing market. New home sales far below expectations in July, plummeting nearly 13% to the lowest level since January 2016, according to data released Tuesday. Last week, home builders and realtors declared a recession in the housing market as higher house prices and mortgage rates continued to sideline potential buyers and push demands to the lowest level since the turn of the century. Inflation. Not even further good news on the inflation from was good enough to calm investor fears. The Fed's most closely watched inflation indicator, the Personal Consumption Expenditure Price Index, cooled as the slowest pace in more than a year last month, according to Friday morning data, performing much better than economics projected. The Fed. Thus far, the central bank has hiked interest rate by 2.25 percentage points this year. Goldman says the majority of hikes are behind us and predict only a 50 basic points rate hike in September and 25 basis points increases in November and December. However, Powell kept the door open for another 75 basic point hike, and some aggressive activity would surely rattle markets.